derivatives. Okay, so generally before starting any topic, I try to discuss about the why of it. Okay, uh, in your CFA syllabus, where does derivatives fit in? Where does derivatives fit in? Hmm? So, okay, what are the subjects in your CFA? Hmm. 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 So this derivatives, equity, alternative investment, fixed income, what are this? Asset classes, right? So derivatives is one of the asset classes. Okay, that is one thing. From exam perspective, what is the weightage of the subject? 5 to 8%. The least weightage that if any topic is there, it is derivatives. Okay, derivatives and portfolio management and AI. Okay, these three topics have least weightage. However, I think I've told in the past also, the weightage concept is purely from assigning the number of questions. Okay, if it is having 5 to 8% weightage, means 5 to 8% questions will be from derivatives. Okay. However, before the scenario was different. If I had ignored the derivatives, it was okay. Or if I had ignored AI, it was okay. Even if I did not prepare AI, it was okay. But now you have to score 70% in derivatives also, 60% or more in derivatives also, in AI also, in all the topics. In ethics, you have to score 80% or more. Okay. So, weightage wise, there's only proportion of questions. Otherwise, all the topics are important. Okay. All the topics are important. FSA, what is the weightage? 15 to 20. 15 to 20 is only ethics. 13 to 17. Okay. FSA is 13 to 17%. How many modules are there in FSA? 12. How many modules are there in derivatives? 10. Now that 10 is actually 3. Okay. In the syllabus that you had before, actually 2 only. Okay. Like 2022 syllabus, if you see, not 23, that 2 only has been split into 9 or 10. Okay. 9, if I'm not wrong, how many modules you have? Check. 10. No? Okay. 10. Right. Effectively, I look at it as 2 modules only. Okay, 2 readings. And FSA was 12 readings before also, now also 12 readings. So for 12 readings, I'm getting how much marks? Roughly around 17% of the marks or 15% of the marks. For 2 readings, how much marks I'm getting? So which is more beneficial? ₹2 கொடுத்தா 8 கிலோ டொமேட்டோ கிடைக்கும். கரெக்டா? 12 ரூபா கொடுத்தா okay. Wrong analysis, wrong example. With less effort, you are getting more marks. Right? So that I will complete derivatives first. I'm not telling don't study FSA. You have to study. You don't have choice. This is important. But the smaller weightage topics, I will try to finish quickly. Or the readings which are less, I will complete quicker. Okay. So this is one aspect. From exam perspective, this is important. Now, what is the relevance of this practically? Why are we studying this subject? Right? Why it is included? Why it is an asset class? Okay, that is also important. Okay, practically speaking, it has a lot of significance. Okay, be it in terms of markets. Okay, it is not only for the purpose of trading. Okay, it is for the purpose of hedging. Okay, it is mainly more used for hedging. Okay, and speculation is also there. Okay, for speculation purpose also. This is in terms of your participation in market. Without participation, how do I use it? Don't want to invest, right? Then where is the use for derivatives? Okay, from employment perspective, from employment and jobs perspective, right? The entire IB operations, right? Lot of roles relate to derivative. Even though you don't have to have in-depth understanding of derivatives, but lot of roles, thousands of roles in Chennai, in Bangalore, in India, you have in operations. Okay, and then IB finance. Okay, investment banking, finance. In lot of this is like you can say little higher level than this from a technical standpoint. Okay, better job. Here also a lot of roles are there. This is apart from your trading and those things. From jobs perspective, how do I use why derivatives are relevant? In fact, more openings are there in this compared to equity. Okay, compared to a lot of people think equity, equity, equity. Yes, for investing, for investment, for participation, equity is more important or more, it has more number of opportunities. But from a jobs perspective, derivatives has a much more broader scope. From that perspective, it becomes important. So then, so practically, why it is important is this reason. Okay, so if I prepare properly, tomorrow where it will come and use, where it will come and hit me, then I go for interview. Point one. Okay, step one is exam, step two is interview, step three is on the job role. Right, I have to have the understanding. For example, my own case, I don't have any participation experience. I have not traded a single trade in derivative on myself, on my behalf. Neither on others' behalf I have done. But my entire experience is from my job on derivatives. Right? So likewise, the practical applicability can be either through jobs, which is like much more possible, and if you are going to trade, then participation. Okay, so this is the practical aspect of it. Okay, as to how derivatives are important and how derivatives are relevant. Clear? Okay, fine. Now let us look at the topic. What are derivatives? Yes, Rohan.
It's a kind of agreement between two parties,
Hmm.
and it's a financial instrument.
Hmm. Tell me.
Examples include future
Hmm.
options
Hmm.
and swaps.
Hmm. Good.
Derived from an original contract or a security.
Derives
A contract derived from a security or an index.
contract derived from a security.
Yes, sir.
Okay. Yes, good. Any other response?
It derives its value from an underlying. It does not have a standalone properties dependent on
Derives value from an
the bond or
yes. Anything else?
Purely based on underlying asset.
Purely based on an underlying asset.
And predicting the prices, for example, if we are predicting a company's price future, so it will then it will appear. It has an expiry.
Predicting prices in future. I'll come. Yes.
contract for a future.
Contract for a future date. Very good. Any other response?
It has an expiry.
It has an expiry date. Hmm. Yes. I got the definition already. If I combine all these options, all these points. See, my effort is less. I'll ask you guys only. Yes, any other point? What is a derivative? Hmm.
It's also not to predict the future,
Hmm.
but also in whether the price is going up or it's down, and it also used to predict the demands and supply other than the investments. In offline, I predict the market's demands and how it goes up or down.
Example.
Example, if you are saying that the job, right? So, while analyzing the present or history data, I can able to predict the future. So,
No, but how is derivative useful? How is a derivative applicable in that?
yeah, sir.
So able to determine
by
the
analyzing the
One second.
Yeah, sir. So by analyzing the operation of the company,
Hmm.
how it's performing and how its growth rate is going
Hmm.
up or down.
Hmm.
Due to that, and based on that, I will predict the future performance of that company.
Correct, but that is forecasting.
Yeah.
What is derivatives here? They're telling it helps in forecasting.
Yeah. Right, sir.
Okay, fine. Yes. Online, someone was participating. It helps in it is
It is used to hedge against an uncertainty.
used as an hedge. Okay, question. What is derivative basically? Okay. Yes. So all the answers are correct. Okay. Meaning is it derives its value from an underlying. Okay. The underlying could be an asset. It could be anything. Okay. The underlying could be anything. Underlying could be an asset. Asset means it could be your equity, your commodities, right? So basically equity, commodities, okay, bonds, fixed income, securities, okay, it could be interest rates, okay, gold, silver, all these things.
credit default swaps.
Yes, come again.
Credit default swaps.
CDS, okay, credit default swaps, okay, swaps. Then it can be on
Option.
it can be on whether derivatives we have, whether it is going to rain today or not. We have derivative on that.
Indexes, sir. The stock indexes.
Index also on entire index you have derivative, right? You have a derivative linked to an index's performance. Okay, so derivative can derive its value from, this is only a indicative list, not an exhaustive list. Okay, there can be many more like this. Okay, derivatives is not cryptocurrency. Okay, cryptocurrency is shooting in the air, okay, without knowing what it is. This is purely for the purpose of, the whole purpose of derivatives was to hedge, okay, the exposure, hedge the risk. That was the purpose why derivatives were used for mainly. How old are derivatives?
When the financial crisis had got like a lot of attention to like credit default was were basically introduced in the 2008 financial crisis. The insurance company hedged against their own around spiraling, snowballing.
Open your material. Read the first para or first page in derivatives. I think new material it will not be there. They have changed it. Yeah, they removed it. Actually, it will be a lot of things. Anyways, so derivatives have been there in the financial markets right from 1980s, 1970s, 1980s. Okay. But it is not only from the financial markets. It has been there in existence for thousands of years. Okay. Cattle stock trade, agriculture, derivatives have been there. Okay. Today also, informally, it is being done. Once the crop is produced, right, wherever the market is unorganized market, okay, where it is not part of a chain where government is involved, in case of unorganized sector in agriculture, once the crop is ready, once the produce is ready, or even before the produce is ready, they will agree with the traders to sell at some rate. Okay. And for example, I will agree and I will have a token or a piece of paper where I've told that, okay, I've agreed to sell this to this person for XYZ price. Okay. And when the crop is ready, when the produce is ready, I will deliver it. Or the other option is, instead of delivering it, I will sell this price, this token to someone else. Right? Because the other person has, let's say you are the other person, you are also having one pair of token. I have one token and the other pair of the token is with you, which says that you have the right to receive the delivery of this produce. Okay? At X price. Okay? Let's say tomato. Today, for example, you have a piece of paper which says you can take 2 trucks of tomatoes at 20 rupees a kg. Okay. You have this piece of paper. This was agreed 6 months back, 3 months back. Now, this piece of paper is valued at much more higher rate, right? Why? Because there is very high demand. The prices in the market, actual market, are totally different. If this piece of paper can be given to another person, he can also take the delivery, then that becomes a derivative. If the agreement says that only Tanigai Nathan and Kamal Kishore can trade, only I can sell and only he can buy, then this is not transferable, right? In that case, it may not be called as a derivative. So, derivatives have been there for thousands of years, okay, in the trade, in the financial markets, right from 80s, 90s, it has started into being. Then it exploded in 90s and early 2000s. Then after 2008, it came down. Okay, because of the crisis, but it is being used as hedging mechanism and also for trade purpose. Before 2008, before 2009, before 2010, there was regulation was there. It was not enforced much. Okay, it was not enforced much. After 2008, 2009, 2010, the enforcement came in. Okay, you have this act, SOX. Okay, you can go and check what is SOX Act in the US. Okay, it was there before also, but started getting applied much more stringently in 2009-10. Then one more example you can read as to what is the risk of derivatives. Okay, what is the problem with derivatives? One more example you can read is about okay, this fellow was employed in UBS. Okay, he was a trader there and he was involved in a scandal which cost this bank around $2 billion at that time, 12 years back. Okay, he traded on derivatives. Okay, he traded on derivatives and the loss because of on the back of those trades, okay, ballooned. Okay, it went uncontrolled and finally it went beyond the point, it got exploded. Then it came to know, it came out in the news. Okay, and it so happened that this company, this bank, UBS, had to incur a loss of $2 billion. Okay, now he was playing on the back of all this derivative positions. Like this, lot of examples. This is close to my heart because when I was in the peak of my work, this was happening. Okay, parallelly, I was doing the same thing. I was not doing scandals, but I was working on the same thing, and something similar is happening. Okay, so this becomes, and I think this was a very big thing at that point in time. I don't think anything bigger than this happened after that. Okay, in last 10 years, other kind of scandals are there, but involving derivatives and accounting frauds. Okay, this was one like biggest scandal, one of the biggest scandals you can say in the financial markets in last 10-15 years. Okay, so this is something you can go and read. Okay, very interesting. This fellow was jailed and is already out from jail now. He's in his hometown, and you can read his part of story. Then he became a hero in Africa actually. Okay, he became a hero in Africa. Why? Because he was talking about what are the ill or bad things about the financial markets in the Western world. Right? This is always there, right? The Western world and the other part of the thing. So he was talking about the other stuff also, which is also interesting. You can go and read about this. Okay. So the point is, derivatives were used for, or the main purpose is to cover the exposure. Okay, to cover the exposure, to cover the risk. That is the main objective. Okay. Now, how this exposure or risk is covered? Let us look at one example. Yes, definition of derivatives is that's all. It derives its value from an underlying. Underlying could be anything, right? It could be equity, it could be asset, it could be anything. Okay, it could be currency also, FX. Okay, forex also. So looking at this forex, we will look at one very simple example. I regularly use this example only. Okay, let's say I am an importer. I am a trader of this projector, Epson projector. Okay, and let's say I import it from Singapore. It is not manufactured in India. I import it from Singapore. Okay, I import it from Singapore and sell locally here in India. Okay, let's say each projector cost. Okay, is 1000 SGD. What is SGD? Singapore dollars. Okay, roughly what is the rate of one Singapore dollar? Roughly 60. Yeah? Now it is 60. Okay, so roughly rate is 60. So 60,000 rupees import price. Okay, I have placed orders for 100 numbers. Okay, what is my total bill? Huh? In INR as well as in SGD. What is the total bill? Total bill today is 100K SGD, right? 100,000 SGD, and value is 3 lakh rupees. Okay, this is the bill today. Now, I'm not paying it today. The vendor is giving me time, right? 2 months, 3 months time. I'm getting it. Okay, so I'll pay after 3 months. Let's say I'll pay on October. Okay, in October I'll pay, or let us say on 30th September. I'll pay on 13th September. Okay, how much I have to pay? 60 lakh rupees. I pay 60 lakh rupees, or should I pay 100,000 SGD? 100,000 SGD. My invoice will be in. My invoice will mention 100,000 SGD. It will not mention 60 lakh rupees. But in my books of accounts, the liability is at what value? Today, 60 lakh. Okay. So on 30th September, payment date. Okay. When I am paying, right, this is INR 60 per SGD. This day, will the price be same of the Singapore dollar? It can be more or less. Let's say it is 62 INR 62 per SGD. Right? So what will be, how much will I be paying? I'll be paying 100K SGD, which will translate to how much? 62 lakh rupees. That means what I will do on that day, I will buy 100K SGD, okay, for 62 for INR 62 per SGD each, per SGD, right? So my total outflow is 62 lakh rupees. Okay, मैं ममता बनर्जी नहीं हूँ, मुझे देखना नहीं है. हाँ. Keep writing. Okay, these examples. Your books has your material is also having these examples, but little complicated. Okay, they are made actually the syllabus they are made little complicated, right? You don't have easy examples, you have little difficult examples. But once you understand the topic, then you can work out those examples. So my total outflow is 62 lakh rupees. Now, my liability was how much? 60 lakh rupees. But how much I am paying? 62 lakhs. Now this 2 lakhs is what? Loss. So I will debit my P&L. Right? Now this loss is because of what? This is because of change in FX rates. My vendor, he is not concerned. He is telling me, you pay me 100,000 Singapore dollars. That's all. He is not concerned about you are incurring 62 lakh rupees or 58 lakh rupees. But as a dealer or as a business, have lost 2 lakh rupees, 2 lakhs on a bill of 60 lakhs, 3% impact on my GP margin, right? 3.33% on GP margin, correct? Because I'm purchasing and selling this, my selling price will not change because FX rate changed, right? 3% impact on GP margin. That means my GP margin directly will go up or come down by 3%. It will translate to 10% on my net profit margin, which is a big money. On a bill of 60 lakh rupees, you're incurring a loss of 2 lakh rupees. It's a big money. The margin will be 10% on this trade, not more than that. Right? So as a business, as a finance manager, as a CFO, I cannot afford to lose this 2 lakh rupees like this. Right? So what is happening? This 60 lakhs is an open exposure in my books. This 100,000 Singapore dollar in my balance sheet. In my balance sheet, when I'm having this liability, trade payables, right? Even though I will mention 60 lakh rupees, in notes, I have to say, or it is there that the exposure that I have is 100K SGD. And this is open exposure. We call it as naked exposure, open exposure. Why open exposure? Because this 100K SGD can translate to any amount. It can become 60 lakhs, it can become 70 lakhs, it can become 50 lakhs, it can remain 60 lakhs. But this is an open exposure. That means this is a risk. This risk needs to be addressed, covered. Right? So this risk is coming because of what? Because of currency. Right? So because you have a currency where you have an open exposure whose value can swing in any which ways, right? Then you are supposed to cover it. If you have an option, if you have an option in place, if you have a way out, you should cover it. Now the question is, for that matter, everything in balance sheet is open. Everything in balance sheet value can change. For example, yesterday we were talking about inventories. Right? I have inventory. Right? Inventory value can change. Then am I covering that also? Assets, I have other assets. We were talking about PP. Right? Are we covering those also? In a way, yes, your insurance. If you take insurance, you are covering that. Right? Inventory also, insurance is there. Insurance is there. Protection from damage, protection from theft, protection from fire and all those things. But not protection from change in value. That risk you have to take. Right? There is no cover for decrease in the value of the inventory because of market forces. You don't have an option. That is a risk. You are doing business. That risk you have to take. This is also a risk only. You can say this is also business risk. We are doing import, export, the currency value can change. Yes, this is a risk. But as a finance manager, as a CFO, my responsibility is risk management. Risk management is my responsibility. Risk management, which risk management? Financial risk management is my responsibility. Right? Then I have to see whether I can cover it or not. Right? So one way is it only through derivatives you can cover it? No. There are a lot of other options also, right? Because we are in the context of derivatives, we'll see how derivatives can be used to cover this. So it is not only through derivatives I can hedge this. Hedge means what? Hedge means protection. Hedge means cover. Hedging. Hedging is a process, means in local language or in layman's term, we can say it is a cover. It is a protection, like your umbrella. Okay. So it is not only through derivatives we can do all these things. There are other ways also to do it, but how we can do through derivatives is what we are going to see. So now what I will do here? Huh? So we will see now how I can use derivatives to cover this. Okay, clear? Did we understand this is very simple, a normal day-to-day business activity, business transaction, how a business is facing risk. Okay, and there is absolutely zero control over these things by a business, right? These are macroeconomic factors. Okay, now what do we do? Okay, so derivatives, how we'll see how derivatives can be used to address this. This is one example. Similar example, you can talk about trading in equity stocks, right? I'm taking a position on equity. I'm buying the shares. Which company got listed recently?
Idea forms.
Huh?
Idea forms.
Idea Forge. I do not know. I'm asking you. What was the rate?
So 635 was initial rate.
Listing rate, listing price,
15% gains.
15% gain.
Thousands.
Okay, 15% is not 1,000. 40% is 1,000. 50%, 60% is 1,000.
15.
15 means it would have got listed for 750 rupees or something. So let's say, okay, I purchased it at 635 rupees. Okay, then I had a fear whether this price will come down or not. So then I'm using a derivative to cover this exposure. Okay, so let us see how we can use derivatives. What are different types of derivatives? Anyone has any doubts so far? Okay, the first set of derivatives are forwards, and we have to understand derivatives is not only for stock market. This you have to keep in mind. Okay, derivatives are there for all the businesses use derivatives. All bigger businesses use derivatives. Okay, in one form or another. Forwards. The first thing is a forward contract. Okay, so you have different types of derivatives. Within that, forward is one type of derivative. What is a forward contract? Think your point.
Agreement between buyer and a seller to
Yes. What is a forward contract?
an agreement between a buyer and a seller to buy to take delivery of the securities or any contract
Hey, hold
at a fixed
on, man.
price.
Agreement between
Buyer and a seller to buy
then
or take delivery at a certain price within a certain period, with an expiry date or something, with a date attached.
at a certain date,
Yes, sir.
right? Right? Is this what you wanted to convey?
Yes, sir.
Good. Need the response.
Only one buyer and seller is not derivative. It should be, because in your example, if you and me alone is agreement, then it is not a derivative. It should be again transferred.
No, we'll see. I'll come to that point. I'll clarify. Yes. Any other response? What is a forward contract? Hmm. Okay, something similar. At a predetermined price. Okay, at predetermined date. Okay, anything else?
No intermediaries.
No,
Intermediaries.
no intermediaries involved. Happens in an unorganized manner.
Customer contract.
In an unorganized means what?
Nobody's there to monitor the risks of
So OTC did
OTC, okay.
customer contract.
Customized contract, okay. Hmm?
Exit from the position is
Coming out is difficult. Okay, now,
Obligation to sell the product or commodity, but derivative, but not obligation to buy. Just an agreement to between buyer and seller.
Hmm.
The seller is, there's an obligation for the seller to execute the trade, but there's no obligation for the buyer to do this.
that is options.
there is no collateral or margin has to be.
Okay, now we'll come to the features, but what is forwards? Features of the forwards will come, characteristics. What are forward
So
contracts?
we are fixing a price that in future, whatever happens, I'm gonna pay this price for this quantity. And then how we in a very in
Here the profit and loss will be equal.
Yeah,
Suppose in
yeah.
her example, if the profit is 100, then for the other party, the loss will be 100.
Zero sum game. Okay.
So, sir, the forward is basically is entered today for a future date to exchange the commodity underlying asset at a price, at a fixed price. So it
Hmm.
entered today to exchange the goods or the asset on the future dates. So to mitigate
Hmm.
the risk and to speculate.
Hmm.
So this is a basic idea of the forward contracts. This is
Okay. Okay, I'll give one more example. All what is being discussed is correct. Let us take the discussion a little further. We're telling it is an agreement between buyer and seller to take delivery at certain price at a certain date. Okay. Now let's say I'm a trader. Okay. Okay, in this case itself, let us talk about this Epson itself. So this case, whatever we did, is it an agreement between buyer and seller? Right? Delivery will happen after certain date, right? At a certain price. Yes. Then is this a forward contract? Forget about this risk exposure and all. This first transaction, this as of today, whatever happened, this delivery will come after 1 month, 2 months, or 10 days, 15 days. But this transaction, is it a derivative? Is it a forward contract? Depends on that. This is the what depends. I've told everything.
So if one party has a right to back out of
Where is the question of right of backing?
It is not a forwards contract, sir.
Why?
Because
You only
the
told
deli-
no. Agreement
but it
between
has
buyer and seller to take
it
delivery
has
at
been
certain price.
delivered at earlier itself, sir. The projectors have been delivered earlier itself.
No, projector can be delivered after 1 month also. Today I've given the order.
Sir, then it is a forward contract.
Then it is a forward contract. This is a forward contract.
But without expiry dates and also. So
Expiry date illappa. Delivery payment date is given. Is this a forward contract?
Here the underlying is the projected, but not the currency. But in derivatives, we're talking about the currency.
No, derivatives underlying can be anything. Underlying can be anything.
It's only credit period then.
Hmm?
Credit period. It's 33 months, it's only credit period.
3 months is credit period. 1 month is delivery. Delivery can happen later also, right? Huh? What financial market? You and I can enter a forward contract now. Yes or no? Then is this a forward contract?
There is no hedging of this. It's just buying the project. So,
Who told derivatives is only for hedging? No, forget hedging and all. What did you tell me? Agreement between buyer and seller, right? At a predetermined price, at a predetermined date, no intermediary, right? No, happens in an unorganized. Unorganized meaning was a different meaning, not.
the purpose is to hedge the risk of no uncertainty.
Who told? I enter into trades to make money, speculation, to cover my risk. So is this, what is the difference between this definition which you guys told and this definitions which you guys told and this transaction?
I think if the transaction was like 100 SGD, that person will say, irrespective of what the exchange rate will be, on 30th you pay 60 at 60 rupees, and if it was fixed like that at predetermined price, only it is forward.
No. Price is predetermined, 100,000 Singapore dollars, 1,000 Singapore dollars.
Not considering any other change in prices in the market.
No.
Maybe the purpose.
Forward contract also, agreement is between buyer and seller to buy and sell. Now, if I'm entering into at whatever be the cost or whatever be the condition, if I have agreed to deliver to you, I will have to deliver to you.
The purpose of the trader is to resell. Traders for hedging or speculation.
No purpose, there is no defined purpose of derivative. I can use derivative for anything. You cannot
So
ask.
the main
Huh?
difference is the forward premium, sir.
One second. Huh?
Yeah, derivative should also always be a cover. So what is cover?
Not necessary is what I'm telling.
Who has it fixed?
Derivatives, that is what I'm telling. It was used for hedging purpose, but it is not only used for hedging purpose, it is used for speculation purpose also. I can take a derivative position to make money, simply. Assume risk and make money, not for the only for the purpose of covering the risk. Yes?
Sir, the main difference between that example and what we are discussing is the factor of forward premium. There is no any additional consideration we are going to pay to the seller for that projector we are buying. So it's just 1,000, that 100,000 is SGA Singapore dollar only we are going to pay, with or without the currency fluctuation. So the forward premium is the basic thing which we will pay for fixing the prices in future date. That is the main difference between this discussion and the example.
No, say forward premium is basically from a pricing perspective.
Yes, sir.
Okay. Premium is what? Small. It is not going to be 65 rupees, 66 rupees.
Yes, sir.
Okay. That is more from a pricing perspective. But per se, the contract, we are talking about two transactions. One is 9th July and the other one is which we have discussed here. What is the difference? No, here also, in this case also, I can make the payment after 3 months, after 2 months, after 4 months. That is my agreement with the vendor. Right? Delivery can happen at a different time. At an agreed date. What you said? At agreed date, at agreed price. It can be tomorrow also, right? Not necessarily 6 months. Then
Because the payoff is not flat. The payoff is not
Where?
flat. A certain balance is not matching.
where?
So for example, in my balance sheet, as of today, it is 50 lakh,
Hmm.
right?
Hmm.
So it can change 62 lakhs or it can change.
That the other party is not concerned. Right? In case of forward also, other party is not concerned. He is what he is telling, you have agreed to buy, I have agreed to sell. So we have to both of us have to honor our commitments, come what may. Tomorrow price changes, whatever change happens, you have to buy and I have to sell.
Forward can be non-deliverable forward.
No, if it, deliverable forward.
So forward contracts can be cancelled off, we can back it off. But this is an honored commitment. We should honor it anyway, right?
Forward contracts you cannot back off. How can you back off? You're
No, sir.
bound by a legal agreement.
Yes, sir. I'm bound by legal agreement. If I don't want that cushion of that edging the currency or whatever I'm committed, I can cancel it off. I can pay the charges. I can come, right. This is between.
So same way here also I can cancel the order, no? I
Oh, you
can
mean
cancel the order, right? Amazon 7 days return back policy. I can cancel the order. I can talk to vendor. What will happen? I'll go to Singapore one day and come back, go meet him, convince him, pay some damages and come back. What? One trip costs what? 20,000-30,000 rupees. Not a big deal, no? If I want to cancel the order, I'll go and seek apologies. I'll write a letter. I'll take some sweets from here. Over. That fellow will get convinced. Okay. Good discussion. Lot of your points. They're close enough. Very simple. Here, the liability to pay is now. This is a normal business transaction. I am liable to pay from now. Order has been given. My liability, I am showing the liability in my books. Even though you have agreed to pay after 2 months, 3 months, 4 months, I am liable to pay now and is liable to dispatch now. 7 days, 10 days, whatever is the agreed period. Here, liability to pay will happen when? On the expired, on the fixed date, future date. There is no liability assumed today. Here, you have already bought. Delivery is pending, payment is pending. In this kind of transactions, payment could have happened before also. Right? Payment could have happened on this day itself. On 9th July also payment can happen. Payment can happen after 3 months also. Similarly, delivery could have happened on 9th July. Delivery can happen after 3 months also. After 2 months also. That doesn't matter. But here, delivery will also happen on the certain date and obligation to pay will also happen on certain date. Same date, yes. Correct. Are you getting it? The minute difference is this. Here you are agreeing to do the transaction at a future date. Here you have already done the transaction and you have agreed the outcome of the transaction. What is the outcome of the transaction? Payment and delivery. Delivery could have happened before, payment could have happened before, or both will happen in the future, or one can happen at a different time, one can happen at another time. Here, the transaction itself will take place at a future date, not today. I'm only agreeing to transact at a future date. And you have to do the transaction on the future date. If you are agreeing to buy, you have to buy. If you're agreeing to sell, you have to sell. So this is a normal business transaction. This is a derivative contract. Okay. What is a forward contract? I will take from this only. Agreement. It is a contract or agreement, okay, between two parties to buy or sell the underlying. Write like this only. Don't write in a sentence. Okay, write like this. Okay, it is a contract or agreement between two parties. These two parties could be you and me. It could be you and a bank. It could be you and a company. It could be you and a shop. It could be you and anyone. Or it could be one shop and another shop. It could be one business and another business. It could be one company and another company. It could be one financial institution and another financial institution. Generally, it is between a firm, a company, and a financial institution. Okay. To buy or sell the underlying. Okay. At a future date. Okay. Or a fixed price. Okay. So, very important. Understand, this is not a book definition. This is a practical definition. Okay. It is a contract. Okay. What is the implication of it is a contract? That means you are legally bound Whether tomorrow that fellow is not honoring his commitment, that's a different thing. But he is legally bound, you can take him to the court. Okay, this we have to understand. Because what happens many times, people say forwards and futures. In forwards, I can back off. In futures, I cannot back off. In forward also, I cannot back off. I can take you to the court. Very simple. Okay, contract or agreement. It is between two individual parties. Okay, it is between two individual parties. Individual means not individual. It is between one company and another company, or individual and individual, like that. Okay. What is the purpose? To buy or sell. I can either buy or I can sell, and the other party will be selling or buying. Okay, the opposite. What? The underlying. There has to be some underlying. The underlying can be currency, it can be an asset, commodity, equity, bond, anything. Okay. When? At a future date for a future price. Okay. Nothing is paid today. You don't pay anything today except for transaction charges, which is very, very minimal. It can be 50 basis points, 20 basis points. What is 50, 100 basis points means what? 1% is 100 basis points. Okay. It can be 1%, 0.5%. Some transaction charges. Apart from that, you don't pay anything on the contract. Payment will happen only at a future date. Okay. Nothing is paid today. And these are highly customized transaction. What is customized transaction? I can enter into a derivative, okay, to buy. Let's say here we talked about 100,000 Singapore dollars. It could be 95,000 Singapore dollars. It could be 101,000 Singapore dollars. Okay, the delivery date could be 7th October 2023. Right? It could be 36 days. It could be 45 days. It could be 34 days. It could be 97 days. Right? Customized the way I want. The way both of us can want, we can customize to suit our requirements. Okay. What is a very good example of a forward contract? Farmers something relating to you guys. How many dollars? 1,522 or 90 $22. So let's say I want to register after 3 months. Right? All of you can go today to a bank and take a forward contract. All those who have not registered. $1,522 I have to pay. Right? Today, let's say dollar is how much? 83? 83? Okay, 83. Let's say you expect, you have studied CFA, you have done some analysis, you expect the price to go to 86. Right? So what is the difference? In terms of INR, 4,500 rupees you can save. You can buy the CFA calculator. Right? A lot of people don't buy the calculator. 4,000 rupees, 4,000 rupees. He has already committed 1.5 lakh rupees. 4,000, that fellow will not buy the calculator. Okay, telling it is costly. Okay. So, nothing is paid today. It is customized transaction. This is the meaning of a forward contract. Okay. And because it is a customized transaction, because it is between two individual parties, okay, let us understand the implication. So that means this is legally bound to oblige both the parties. Okay, because it is between two individual parties, there is a counterparty or credit risk. There is always a risk that the other person may not oblige. Okay, there is a risk that other person may default. Okay, this is the implication of these things. There is a counterparty or credit risk. Okay, nothing is paid today. Okay, so tell me, if that be the case, what is the value of this forward contract which I have entered now? Let's say I have entered, okay, 3 rupees. I'm going to the bank, okay, and I'm telling that, okay, I want a forward contract. Okay, I want this so many dollars on 9th October. Okay, bank will say 84 rupees. Let's say. Okay, and it says, okay, I'm fine for it. Okay, I will go for this contract. Then he will say, okay, the total value of this transaction is 1522.84. okay, into let's say 0.5%. Okay, pay 640 rupees. Roughly, I do not know the charges. Okay, he'll say, okay, pay 640 rupees, sign this, and this is the paper. You come on 9th October, I'll give you the dollars. I'll credit to your account or payment will be done. Okay, so this is the transaction charges. Now you have the slip with you. What is the value of that slip? Now, so if you give that slip to me, will I pay you $1,522?
The expiry,
Hmm?
expiry amount minus the charges, sir.
Charges you can ignore, small number.
The
Small number.
expiry,
Huh?
expiry.
Expiry amount, which is how much?
Yes, sir.
That is the value of the slip. So if you lose this slip, what is your loss? Are you okay? How much are you paying today? So if you lose this paper, what is your loss? 639. Your loss is not 127,000. And if I have to buy this slip from you, how much should I pay? Which I can go to the bank and buy myself, right? Why should I buy it from you? So the value of this slip is 0. So value of the forward contract at the beginning. For that matter, value of any derivative at the beginning is 0. Okay, that's important. We will be discussing about valuation probably in the next class or the subsequent class. Very, very important to understand why value is 0. Today, value today is 0.
Future cash flows.
Because you're not paying anything today. You're not paid anything today. Right? There is no value attached to it today. Correct? Okay. Now, 9th October. Okay. Let's say I'm at 9th September. At that day, how much you have agreed for? 84. Okay. On 9th September, the spot market, if you go and buy dollars now, on 9th September, let's say that is 85 rupees. Okay. Then what is the value of the slip? On 9th September. 1 month before this.
Yeah, one.
Hey, ignore 639. Okay, don't get confused. Can ignore 639.
This is not 1,500. So the bank is supposed to put $1,500.
Correct. The value of the slip. Okay. On 9th September, when in the spot market, dollar price is 85 rupees.
I think the future contract
Hmm.
will be 4, so
Hmm.
1522 minus
Hmm.
85 minus 8 is what minus.
Okay. On 9th September, will the slip have any value? Will the value change? So today I told no value. On 9th September, will the value change? Hmm? What did we say? So underlying value is changing or not changing? It has changed. Right? Okay, now what is happening? Now let's say the slip is there. Okay, this slip is giving me a right to buy the dollars at what price? 84, 1 month hence. Okay, today what is the price? 85. So obviously it has got a value. Because if today it is 85, you are expecting it to increase further. Already 1 rupee gain is there from 84 to 85, and 1 month hence you may expect it to increase further. That means you are getting a right to buy something at 84, okay, which is available in the market at 85. So obviously that you have this premium, right? So this is like, okay, in your language, very simple, your Amazon vouchers. If you have Amazon voucher, the price is little lesser, right? You get some code and all those things. If you enter that code, discount, same thing, right? So at this time on 9th September, the value of the slip is how much? 1522. How 1522? 1522 into 84 minus 1522 into 85, which is 1522. Clear? Are we getting this? Now let's say on 15th September, this becomes 87. On 25th September, this becomes 82. Tell me, like this is the value of the slip on this day. Tell me what is the value of the slip on this day and on this day. Hmm? How much? 1522 into 3. And here minus 1522 into 2. You've got a loss here. Okay. So basically, this is what we call it as deriving the value from underlying. The value will keep changing immediately after today. In fact, immediately after this point. So let's say if I've entered into the contract now, right, and if it is a dynamic market, the prices will keep changing every second. Then after 1 hour, the price will be different, right? After today, at the end of today, the price will be different. So at the end of today, there will be a value to the contract. But at the beginning of the contract, which is now, there is no value. Getting it? Okay. So this is your forward contract. Understood? Okay. Now come to Epson example. So here we have an open exposure. So here tell me, what do we do to cover this exposure? Take forward. How do we take forward? Ah,
Go and buy with 100,000 Singapore dollars shares at the spot market rate of 60, 61.
no, you will not, you cannot buy it. If you, okay, good point. If you buy it at spot market, how much you have to pay?
Current liability.
So you have to pay 60 lakhs.
I'm going
Right?
to fix the price.
To fix the price, you will not buy at the spot rate, the forward rate. So you will buy 100,000 Singapore dollars, not 60 rupees, at the forward price. Right? Forward price can be 62 rupees, 63 rupees, 60. It can be anything. Okay. You will agree with the bank or with the financial institution to buy so many dollars at a future date. You will enter into a forward contract. Okay. So let's say you are entering into a forward contract. Enter into a forward contract. Okay. To buy 100K SGD at, let's say, 61 at INR 61 per SGD on 39.23. Okay. Now tell me the steps. Okay. Tell me what will happen to my business on 30th September. What all transaction I will do on 30th September.
Go pay money in INR, convert it to SGD, pay to my export.
How much?
To the exporter, 100,000 Singapore dollars.
Hmm.
And to the bank, where from the financial institution from wherever I've taken the forward contract,
Hmm.
I'll go and pay 61 lakhs.
Hmm. That's all.
So that's converted to dollars in there.
Hmm. Right. So what will happen on 30th September? You will pay bank. Okay, 61 lakhs. This is as per the forward contract. Right. So you'll pay minus 61 lakhs. Okay. Receive from bank 100K SGD. Pay SG vendor what? 100K SGD. So your net outflow is 61 lakhs. Your liability was 60 lakhs, but your outflow is 61 lakhs. So your loss is 1 lakh. So by this process, your loss is limited. Right? Your loss has been capped. Correct. Right? To some extent, it has been arrested. Okay. Now this is a normal way in which the transaction will happen for a deliverable. But generally, what will happen is this is normal transaction. Generally, what will happen or what happens is I will 61 lakhs is the rate. Okay. We will also see what is the spot rate on that day. Right. The spot rate on 30th September. Okay. 30th September is what? 62 INR 62 per SGD. Okay, this is the spot rate. What will happen is
Everything you need to know about Apple is at Apple's website.
okay, what will happen is instead of taking the delivery, right, we'll settle the difference. Okay, with the bank. Okay, what is the difference? 1 lakh, right? So I'll pay the bank the difference between spot and future or the forward price, between spot and the forward price, which is how much? 62 minus 61. Your spot price is 62 and your agreed forward price is 61. So 1 lakh you will pay. And if it is a gain, you will receive from the bank. Okay, minus 1 lakh you will pay. Whom you will pay? You will pay with the counterparty with whom you entered into the forward contract. Okay, then buy SGD from the spot market. Hold on. Will this be minus 1 lakh or plus 1 lakh? Why plus 1 lakh? Because
Forward is 62 and I'm entering the forward at 61, right?
so what I've told is I've told that from you I will buy it at 61, but in the market it is available 62, right? So if you have to give me, you have to give me at 61, right? So that means I have 1 rupee gain. So that 1 rupee gain is this. Okay, buy Singapore dollar from the spot market, which is at what? 62, right? So the outflow that I'm doing is minus 62 lakhs. Right? And receive 100K SGD and pay SG vendor 100K SGD. So from the market, receive from the spot market 100K SGD and pay the SG vendor, Singapore vendor. $100K SG. So net, your outflow is minus 61 lakhs. Okay, this is for NDF, non-deliverable forwards. This is for deliverable forwards. Non-deliverable means you settle the difference generally. You settle the differential amount. Clear how forward can be used as a hedging mechanism. Okay, as a tool to cover your open exposure. And it is not, as I said, it is not only the forward contract, or it is not only a derivative which can help you to cover the risk. There are different ways, okay, in which you can cover the risk. One of the ways is to use a derivative, and within derivatives, one of the ways is to use forwards. You can also use similarly futures or options also for this. Clear with this? Did you understand forward contract?
So for example, if you take a company like Gucci Soya, which is an agricultural income company, right? So soybeans are getting very increase in the price will go down or it can go haywire. In that scenario, how do we execute this in an agricultural crop? Do we use the same mechanism?
No. See, what will happen is
The effects, I just want to understand like, how does it happen in agriculture?
agriculture also. See here, my view is the dollar rate will go up. But if my view is dollar rate will not go up, it will come down, I'll keep quiet. I'll not do anything. Right? So similarly, in the other market which we are talking about, agricultural market, if I'm confident that my crops will fetch a higher price, I will not do anything. Right? And if my crops are not going to, if I'm concerned the prices may come down, I may enter into a forward contract.
Let's say in market, we rather go for an option than a forward.
No, that is a different discussion. As to where. Now, here also, what will happen? A lot of companies in finance, they will have a policy that you cannot time the market. By default, you have to take forward contract. By default, you have to take a future contract. By default, you have to cover the risk. Right? You cannot opine telling that my belief is the price, dollar price will come down, so let us not go and hedge. Are you getting it? Because as a CFO, my role is not to make money from currency movements. My role is to help the business to make money from the underlying business. Right? My role is to cover the risk. Any open financial risk is there, I should cover it. So a lot of companies have this default policy. The moment you give the order, the moment you do some trade, business trade, if it is coming up with an open exposure, immediately go and cover it. In fact, banks itself will give this facility, right? Where you are taking your term loans or your loans, wherever you are doing transaction with bank, right? Bank itself will give the option to immediately take a forward cover. Okay, and especially if it is an import transaction will be supported by this LCs, letter of credits and all those things, right? So for that, for LC, I have to go to the bank. Bank will know that, okay, if you are coming for LC, that means it's an import transaction, right? Then bank will say that, okay, you have to take forward na theriyada, forward edukalen kepan. Abdina, right? This finance manager who is not that very well qualified, he'll ask, okay, what is forward cover? And bank will explain, give some PPT, will tell, okay, you bring your management, we'll do a meeting in a conference room, they'll present a PPT, they'll say, this is forward cover, this is hedge, this is Epson projector. Okay. And then they'll say, take forward cover. And they will charge premium initially. Then our finance manager fellow will understand what it is. Then he will realize, then no premium and all, normal prices. Okay, clear? Can you proceed further?
How banks will make money?
Huh?
How banks will make money?
Super. Very good question. Okay. I will take this when we discuss swaps. Or, okay, very simple. You have come to buy dollars from me, Singapore dollars. He will come to sell dollars from me, dollars with me, right? I don't think so. This generation is going to bank branches. How many of you have visited branch recently? Bank branch. Very rare. If you have noticed, if that branch has an FX desk where they buy and sell these foreign currencies, they will say the board, there will be a board, electronic board, it will be displayed. Okay, we buy US dollar 83, we sell 87. We buy GBP 98, we sell 105. This is where you make money. Huh? Basically, so if he comes to buy, I will buy from him at 98 GBP. And when you come to sell, 105. So it is a marketplace for the bank.
So, just imagine today, the INR is 83.
Mm.
So I am putting a forward contract
Mm.
to pay my CFA.
For CFA and all, don't take forward contract and all. Whatever is the fees, go and pay.
Just for understanding, sir. So
Ah.
I'm just putting my contracts to my bank.
Mm.
So for 84 rupees, sir. So on that same date, while paying the date, so I'm paying 84 rupees. After that process, they will pay that 1 rupee for me.
Which 1 rupee?
Yeah, sir.
No. Okay.
84. I'm forward putting the contract for 8. Today 83, putting the contract for 84, sir.
Entering the contract.
Getting into the contract. Sir. So on the payment date, I'm paying 84 rupees. Whether they will repay me that 1 rupee.
You will pay how much? 83. You are entering the contract at what rate?
84.
84. So you will pay 84.
So now 83.
No, at what rate you have entered? 84.
84.
Let's say you have entered at 84. On the maturity
On that
date,
day, the dollar will go up for 85.
on that day, dollar can go to any value. You have to pay 84.
Oh,
Okay, 84. And they will give you the dollars.
okay.
Now that operationally, how they will give, whether they will give you the currency or they will credit to your bank account.
Okay.
Okay, what happens in like the small transaction, they will give the currency. Okay, they will take one KYC. Okay, and they will also not give the currency. They will credit an equivalent amount to your bank account. They will ask for what purpose do you need to use this currency. You will say, no, I have a friend to whom I have to remit this money in US, or for this payment I have to do. Then say, okay, give the bank details. We will make the payment. They will not give you dollars. Banks will not give dollars. Dollars you will get from this money exchange fellow. Okay, and larger businesses, bigger businesses, or businesses, when they open the current accounts, I will open a dollar account. I will open a Singapore currency account. I will open a US dollar account. I will open a GBP account. If my transactions are like in different currencies, sitting in China, sitting in India, with these banks, we will open a foreign currency account with permission from the RBI. They'll ask me, why do you want? So then I have to get trade licenses, permissions and all. That will get covered in different regulations, FEMA and all we have. Okay. Yes, any doubts? Okay, fine. Now, let us look at futures. Okay. People online following, anyone has any doubt? Clear? So what is futures contract? Okay. So then I will say wait, same as forwards. Shall I write like this?
These are more standardized in nature, therefore provides better.
So futures contract. Okay. First, I'll go to the definition later. Tell me, what is futures contract? More standardized. Exchange traded. Okay.
There will be intermediaries. So here, the form is going to be in future, there is a category called exchange.
Correct.
Clearing and the settlements in
Mark to market settlement.
Counterparty is reduced.
Zero counterparty risk.
It is not customized.
Standardized trades. Okay. Then have to pay margins. Okay.
It's regulated.
Regulated. Regulated how?
It's the exchange. The exchange is having bylaws. They will be regulated by
The exchange. Okay.
We can also put the contract for below the price. So now the price is 80 means we can put the contract for 87.
That you can do in a few forwards also.
So 80 we can
75. If the view is the prices are going to come down, and if the other party is agreeing, yes, you can do it.
T+0 and forward, we are not like paying
Hmm.
anything. But I think there is some initial payment that is required from
Margin.
either of the counterparty.
Margin.
Margin. Either of the counterparty has to.
Hmm. Basically, customized, standardized settlement dates. Then
They have to buy in spot price. They have to pay spot price. Immediate price.
you have to make immediate payment.
Not spot price. Can't determine if it's a trend. Like we say next day 16,000. They can't buy 19,000.
That is whatever rate futures is available, you can buy. Very simple.
There's a day-to-day trade. At the end of the day, the margins get a
So in forwards, you gave us an example, right? Like for example, if you used to say 64, we don't do anything. But in futures, if the price was supposed to move, both the buyer and seller would have to like assume the profit and loss.
Margin requirement. Settlement is not there.
Yeah.
Okay. All right. Yes. So it is agreement again between buyer and seller. It's a contract or agreement between one party and exchange. It is between one party and exchange to buy or sell the underlying at a future date for a fixed price. Okay. Margin requirements are there. Margin needs to be deposited initially. Okay. Standardized transaction. Value of the contract today is 0. When you enter, the value is 0. Okay. Why do we say no counterparty or credit risk? Hmm? So,
We do the market margin that you have to draw exchange, right? So it assumes a risk. And therefore, there is no, there's very less.
so it is not that, okay, because it is with okay, it is not that because it is with the exchange, you don't have any loss. Okay. Because it is with exchange and exchange has its mechanism of margin requirements, exchange is self-sufficient. How? Now, anyone and everyone cannot go and do the trades with exchange. First, KYC has to be done. Only if you are credible, only if your KYC is proper, okay, only if your credibility is there, you will be allowed to trade. Point 1. Point 2, you have to deposit initial some margin money. What is margin money? Based on the value of the transaction, a certain portion. Okay, now margin requirements for different underlyings differ. For example, equity, can anyone tell what is the margin requirement? It ranges from 10 to 40%. Okay, at different times, different margin requirements are there. Okay, that means if the value of the transaction that I'm entering into is 1 lakh, I'm dealing into shares worth 1 lakh rupees, I may have to deposit 30,000 rupees. I don't have to pay 1 lakh, but I have to deposit 30,000, right? So that tomorrow, if my loss is becoming 10,000, margin exchange will deduct this 10,000 from this 30,000. They will not wait for the settlement date, which is after 3 months, to come and pay 10,000 or 20,000, whatever be the money. Now, what if margin money is getting exhausted? Okay, square of a lakh. you'll get a margin call. Okay, you'll be notified to deposit additional money. Otherwise, your contract will be squared off. Your trade will be closed. Okay, now how this works, let us see. Let's say I'm entering into equity shares. Okay, I'm buying a futures contract. Okay, for some XYZ underlying equity. The settlement date is 30th September. And the agreement is to buy, okay, at agreed prices, let's say at 100. Okay, today's date is 9th July. Okay.
What is the notional for?
Notional, you can say 1 lakh rupees. Okay, so 9th July, I am entering into the contract. Okay, what will happen is on 9th July, EOD, end of day 9th July. Okay, the price will change. Dynamic market, the price keeps changing every second, right? At the end of the day, on this day, the spot price, okay, the spot price is 80 rupees. Okay? End of the day, the spot price becomes 81 rupees. Okay, spot price. Spot price is becoming 81 rupees. At the end of the day, the future, not forward, the future price is becoming 105 rupees. Understand the difference? Are we dealing in the spot market or are we dealing in the futures market? Futures market. So this 81, I will not even look at. This 81, we will not even look at. Right? We are not concerned about spot market. So if at the end of the day, if I have to enter into a similar forward futures contract with 30th September maturity, I have to pay how much? 100.5. That means on 30th September, I will have to pay 100.5. Okay. Clear? Now, what is the value of this future contract here and here?
Entering is zero.
Zero. Here,
Exhibit is 1 lakh notional into 1.5 lakhs. I'm going to receive 5,000.
basically 0.5. Right? Into how much? Into 1000, which is 500 rupees. Your gain is 500 rupees. Because you have entered to buy something at 100, whose value is now 100.5. So this we call it as mark to market gain, right? In financial markets term, this is also called as day one PNL. In financial reporting, we call it as day one PNL. Okay, 500 rupees.
That will get added to my margin.
That will get added to your margin, correct?
This is my executed minus your release.
Yes.
How will this be added to my margin? Okay.
So you have this 500 rupees, right? So it will get added to the margin. Whatever is your margin amount, it will get added to your margin. Let's say your margin money is, let's say 20,000.
This I initially deposited. Okay.
So then today you made 500.
Okay.
This 500
I
will
have
go.
to deposit again.
You don't have to deposit. This is automatically getting added.
100 rupees is the exercise. And 100.5 is the current price at the end of the day. What is 80 and 80?
That is what? This is the spot price today. This is the future price. At the end of the day, evening, if you enter into this contract is available for 100.5. Futures price only. Evening, let's say today 10 o'clock you entered at 100. Okay, evening 5 o'clock or close of the market, at that time, if you want to enter, you will get at 100.5. 81 is the spot price to buy the market, to buy it then. Everyone understands this? How we got the 500? 100.5. This is 100 is my price. Okay, you can say lot size is how much? 1000. 1000 into 0.5. Right? This is called as MTM gain. Now let's say on 10th July, POD, okay, this futures price becomes 98.5. Okay, in that case, what is the MTM gain? Minus?
Minus
1.5.
First minus or plus? Sir?
minus.
Okay.
So that is from 100, right? Not 100.5.
Sir, 1.5. Minus 1.5. Yeah.
So it's either 1500 or 2000.
Hmm.
So you're gonna take 100.5. not
Because you have marked your position to 100.5. The value in your balance sheet is at 100.5. Right? And next day, the value of that asset is becoming 98.5. So you will show a loss of 2000.
marking.
You are marking it to the market. Yes.
So that's what I.
Overall. So day one, you are having PNL of 500. Day two PNL is 2000 minus 2000. So net 1500. Okay. How will your balance sheet look at this point, or at the end of the day one? How will your balance sheet look?
Loss.
On day one, how will your balance sheet look? Day one, end of the day.
Credit PNL, debit inventory.
Inventory.
Cash.
Cash.
So
Are you receiving cash?
how much are you payable? Receivable.
Trade receivables. How much? 500 or 500 or 1,05,000? 1,05,500. Hmm?
My PNL.
Okay. Tell me when I'm entering into the contract, morning that day, when I'm entering into the contract, how will my balance sheet look?
1 lakh will be my payable
Receivable?
and my receivable will be.
Zero. So till now we are not.
So how will balance sheet look?
Payable and receivable are balanced.
Payable to whom? When I'm entering into the contract, what will be there in my balance sheet? So what? Okay, journal entry. Journal entry. Bank account. How much? Payable to bank account. So payable account is
Paying to exchange.
okay. How much you are paying? 1 lakh you are paying.
Like and deposits. As you take the liability only start after the expiration.
How much are we paying?
Just a margin.
20,000.
If you pay 1 lakh, you will go and enter in spot market. Why do you want to come to futures? You do not want to pay that 1 lakh. That is why you are entering into futures, right? Okay. And balance sheet will look like this only. Nothing will be there on the balance sheet except for that margin money. Margin money you pay to the exchange. So receivable 20,000, cash will go out 20,000. Okay. That is why we said value of the contract is 0. Because the value is 0, there is nothing in the balance sheet. This we have to understand. This we covered in income statement. All those who have attended FSA. In income statement, we covered P&L. financial instruments. Okay, because the value is 0, nothing will come. At the end of the first day, only this margin amount will come. That is as a receivable. At the end of the first day, okay, derivative financial instrument is how much? 500, and reserves, basically your P&L is 500. Gain, right? Day 2 it will be
Minus 2,000.
minus 2000 where?
My reserves.
Ah,
Derivative will be minus 500.
Okay,
Cash minus,
accounting for
plus,
everything.
getting it, because you are having a liability now. Right? Of course, this will be offset against the margin money. Right? So this 1500 will be offset against the margin money. Whatever margin you had, from that it will get adjusted.
So at the time of the would be just proportion. Like gain or loss, it's proportional.
Unrealized gain. We call it as unrealized gain or loss, which will go to P&L. Which will go to P&L. Right? For some time, you will not touch margin also. Right? You have maintenance margin, okay, variable margin, and all those things are there. Right? Only when you get the margin call, you will go and deposit additional money. If you are making gain, then no problem. Okay. So this is basically MTM process, mark to market process. Day in and day out basis, you are marking it to market. You are supposed to mark it to market, and whether you don't follow it in your books of accounts, exchange will do, and you will daily get a notification how much is your margin money, what is your accumulated loss or gain. Exchange will keep doing it. Okay. So if exchange is doing it, you also have to do it. And we do it in forward contract also. In forward contract, exchange is not there. But if I am a reportable entity, what is reportable entity? The one which is required to publish its financials to the public or to the regulators, then according to IFRS or based on the government's requirement, okay, based on your company's act and all, you have to show MTM gain or loss on your all your derivatives, including forward contracts. So on your forward contract also, this process has to be followed whenever you are reporting, right? So in certain cases, in certain financial institutions, right, in certain industries, this process is done on a daily basis. On a daily basis, you will prepare the P&L and you will send it to the senior management and the regulators also in case of banks. Okay. Otherwise, all other companies also on a daily basis for derivatives, there has to be a process. Management cannot say, no, it's okay, we don't want to see. No. As an audit requirement, as an internal control requirement, this is a key audit requirement where are you tracking your financial instruments on a day in and day out basis? Is that mechanism is there? Are those reports being presented to the senior management? Is senior management looking into it? Are they taking any decisions based out of that? That is a key control requirement for all the bigger companies. Okay, so for forward contracts also, we follow this MTM process. For all the derivatives, we follow this MTM process. Okay, so because of this MTM process, literally the counterparty or credit risk becomes 0, absolutely 0 or close to 0. Why I am telling close to 0 is what is happening in my experience in last 2-3 years, especially one is COVID. Earlier, we would not see end of the world events. Now, these are all end of the world events like those only. So, till date, I have never seen a case where exchange is defaulting or there are problems because of exchange. But this happened in last 2 years and all. What happened? One exchange in London, it stopped doing transactions. It stopped taking trades. And people incurred loss because of that. Okay. This was a commodity exchange. So, without going into the details, to explain it, because this is very complex, right? To explain it at high level, metals, okay, commodities or metals, you can say. There were people who had taken short positions, especially this was linked to China. Okay. So, there were people who had taken short positions. So, what is short position?
selling and buying.
So I don't have something, but I'm selling it or agreed to sell it. I've agreed to sell this at, let's say, 100 rupees. Okay. Now, if in the spot market, then I will make a gain only if the price is less than 100 rupees. Right? So if I have agreed to sell it, so someone else has agreed to buy at 100. Okay. So let's say I'm on the one side of the exchange. On the other side, this fellow is there. Right? So in the spot market, the prices skyrocketed. It became 500, 600,000, something like that. Right? And this expiry date has come. So when the expiry date came, what I did is because I'm a large institution, like me, there are large institutions who have taken short positions. I told, because I am running the exchange now, I told the exchange, stop doing the transactions. So what happened? So this fellow wanted to buy, he is standing outside. Okay, I want to buy. Why? Because he is agreed to buy at 100. It is available for 500,000 rupees in the market. Right? And I had to sell and I'm not selling it. So now this is like an extreme event. Doesn't happen on a daily basis. It is an extreme event where exchange has stopped taking transactions or trades, telling technical issues. You see, so earlier I used to say these things in books, it will mention no counterparty risk and all. Now I think they've amended, I checked, they will say there are extreme scenarios where counterparty risk is there in exchange also. Why? Because these are privately run. Right? Ultimately, human beings are involved, right? So where human beings are involved, you have to assume, you cannot assume that everything is fine. Okay. So this is about futures contract. Effectively today, the difference between forwards and futures. Now the question is about why futures and why not forwards, or why forwards and why not futures. It all depends upon what your requirement is. Right? If you are comfortable with forward, you'll go with forward. If you're comfortable with futures, you'll go with futures. Right? And OTC trades are also regulated in some market. If it is, see, all the transactions are regulated. You're legally bound in all the transactions. Everything is done through a contract. Right? So that point is taken. Okay. Any doubts on forwards and futures? Did we understand? Now there are questions relating to this. Okay, little complex examples are there. I will work it out later, right, in the subsequent class. First, we will try to understand what are these derivatives. Okay, forwards, futures, options, swaps. Then we will solve some of the examples, okay, that are given in the material, or examples similar to what is given in the material. Okay, any doubts? Okay, so we'll take a break now, 10 minutes break, then come back and continue further.